Morning, everyone. Thanks for joining us this morning. It's not my intention to speak for very long, as I'm going to hand over to Abigail O'Neill, a manager in our VAT team, who is going to speak to you about importing and exporting goods and services to the UK. We're also going to hear from Gavin from Customs Connect, who is going to speak to you about the implications for duty once we leave the EU at the end of the year. In January 2020, I suspect we were all a little bit sick of hearing about Brexit. It'd been an ongoing political drama that seemed to occupy the news constantly. Subsequently, obviously, COVID has reared its ugly head, and since then, all attention has been diverted until very recently. And now Brexit is obviously back on the agenda as the deadline for the UK to leave the EU is looming. Obviously, an agreement between the EU and the UK was agreed in principle in October 2019. However, that agreement has not been ratified, and it seemed that there was still some way to go in the negotiations. What I'd sort of suggest was less oven ready rather than languishing in the bottom of the freezer. But things seem to have moved on. Particularly more disturbing the news that the government and their intention to break international law if they didn't get their own way. And then obviously there were some accusations that business wasn't quite ready regarding the transitional period, and the riposte from business was that actually they hadn't really been given the tools to be ready. And I think there is some truth to that because there are still gaps in the legislation, and Abigail and Gavin will pick up where they still think that there is some uncertainty regarding the rules that we're yet to hear or even understand until we know whether we've got a deal or a no deal. Over the next couple of weeks and months, we're presenting a number of seminars that are looked to guide clients through what we now know and what we don't. So today we're presenting on VAT and duty with a second webinar on the 8th of December with Susanna Cordoba from the Greater Manchester Chamber of Commerce, who'll be speaking about the services that they can offer business in getting ready for the transition. We've also got a immigration solicitor from Knight, Carly Hale, who will be speaking to clients about the implications for free movement of people. So, and what you need to do if you've got EU nationals working in your business at the moment, or you use EU nationals. So we've got some in our business where they use a lot of seasonal workers, either in the hospitality industry or in the construction industry. So she'll be picking up on some of the things that need to be done there. We'll also be holding a third seminar, and unfortunately, because we don't know whether we've got a deal or a no deal at the moment, I can't really tell you what the content of that is going to be. But obviously, as and when we know, we'll sort of fill the gaps and let you know. So that will probably be very early in the new year, unless we know sooner. And obviously, we'll try and get it in before the end of the year, because I'm sure, like me, you're all wondering what it means for us and how are we going to be able to do business with the EU after the end of the year. For now, I'm going to hand over to Abigail, who's going to speak to you about VAT implications in trading with the EU. So over to you, Abigail.
Okay, hi everyone. I'm still finding these Zoom meetings very strange. It would have been much nicer to meet you all in person today, but never mind. Yeah, so I'm Abigail, I work in the VAT team at Cargill's. So I'm just going to share my screen with you all so you can see my slides and then chat through them. So just bear with me 1 second. Okay, so hopefully that's worked. If someone can nod just to let me know that's all okay. Perfect. Right, okay then. So the purpose for me of today is just to highlight to you all some of the issues with Brexit, what's going on with Brexit, and obviously I think everybody wants to keep the goods moving, so I think the main point is to identify any issues that you might have, and then you can try and action them before the 1st of January, or at least, you know, so we all know what's going on. As Lisa said, we don't know if there's going to be a deal or not, so this is all a bit, at the moment, subject to change. Okay, so we are going to send a copy of these slides out to everybody after the webinar, so you are going to have a copy of these. So first of all, I thought it would be useful to highlight what the current scenario is with movement of goods within and outside the EU. And then I'll just talk about some of the simplifications that may no longer apply and the rules, well, the rules as we know it from the 1st of January. So I hope you all like my diagrams. They are quite simple, but we'll see how we get on. Okay, so at the moment, as you'll see from the left-hand side, the UK currently sits within the EU bubble. So what that means is if you're a UK business and you are selling goods to a business in France, you can zero rate the supply of those goods, and your customer in France will account for the acquisition VAT in France. So you've no obligation to register for VAT in France. Your French customer will just account for the VAT and recover it subject to their import VAT rules in France. So there's no duty payable in France, there's no export declaration. You may have to submit an Intrastat and ECSL, but that will depend on your thresholds, etc. And again, if you buy goods, say, from Germany, this will be an acquisition into the UK. You'll account for the VAT via acquisition on your VAT return, and you can recover the VAT return subject to normal rules. There's no duty payable on importation. There's no VAT payable on importation, well, import VAT. And again, whilst we're in this bubble, we benefit from simplifications such as triangulation, distance selling, and call-off stock. Now, I'm going to talk a little bit about these simplifications a bit later on. So if we look outside of our EU bubble, if you sell goods to the rest of the world, so for example, China or India, it will be a zero-rated export for VAT purposes. You'll need to do an export declaration, and you'll need an economic operator registration and identification number, an EORI. That's a bit of a mouthful. And your customer will likely sort out the obligations in the third country. We call it a third country, but yeah. So yeah, there's your export into the rest of the world. And if you import into the UK, say from China, you pay duty on importation if applicable. You'll pay your import VAT. You'll receive a C79 normally the month following the date of importation. That is your evidence for import VAT deduction. So you'll need that to be able to recover any import VAT on your VAT return. That's it's a big cash flow paying all your import VAT, but I'm going to talk a bit more about that later on. You'll need to do an import declaration, and you need an EORI. Now, so now I'm just going to talk about after Brexit and what the changes will be. I just want you to be able to recognise, I mean, some businesses believe that they're already importing and exporting, but if you can see from the diagram, if you're actually only moving goods through the EU, you're not actually importing and exporting at the moment. However, let's go to the next slide. So after Brexit, as you can see, the UK no longer fits within the EU bubble, and the EU is essentially separate. It's similar to the rest of the world now. So for that purposes, if you are selling within the EU, it's a zero-rated export. You'll need an export declaration. You'll need an EORI. And if you buy from the EU, you'll likely pay duty on importation, if depending on the duty rate. You'll pay import VAT. You'll need an import declaration. I understand that from 2021, you're still required to do an arrival Intrastat if you meet the threshold. I think it's just for next year for fiscal reasons. I think it's just so that HMRC can still monitor the movement of goods from the UK to the EU, or from the EU to the UK. And you need an EORI. Normally, your importing is done by a freight forwarder. I understand you can do it yourself, but I'm not sure many companies actually do it themselves. And yeah, you're not going to be able to use the EU simplifications anymore, which I'm going to talk to you a bit later on. Okay, so hopefully that shows the difference between now and from the 1st of January, and you kind of understand the difference between your current supplies to and from the EU, and it is different from importing and exporting from the rest of the world. If you are currently importing and exporting, say, from China, you'll probably be more familiar with the process, and you just need to apply similar logic to your EU supplies. Okay, so there is a bit of light at the end of the tunnel, so to speak. HMRC have recognised that the way that we account for import VAT is quite heavy on cash flow, and it's quite time consuming. You have to wait for your C79, so they've introduced postponed import VAT accounting. So what that means is, rather than paying on importation and waiting for your C79, you can actually account for the VAT on your VAT return. So a bit like acquisition VATs, I guess. So what would happen is, on importation of the goods, you wouldn't pay any VAT, and you will need to put that on your VAT return in boxes 1 for recovery subject to normal rules, and in box 7. Now, I'm not 100% sure how this is going to work in practice. I think we're still waiting for confirmation from HMRC. My understanding is that you don't have to opt into this. You don't need authorisation, but you obviously do need your EORI number and your VAT registration number. And what will happen is, when you do your import declaration, there might be a box that you tick, or your freight forwarder would tick, to say you're not paying import VAT on importation. You'll pay the import VAT on your VAT return and do it via postponed import VAT accounting. Now, this isn't compulsory. I understand that you can still pull the import VAT on importation, but that's going to be heavy on cash flow. I'm not quite sure why businesses would want to do that. But this is an option, and I think it's quite a good option going forward from the 1st of January. So how this will work. So I think how this works is that if you import on, say, the 4th of January, that's your tax point for VAT purposes. So on your VAT return, so if your VAT return period is January to March, that import will need to go on your VAT return. Now, I think that HMRC are doing an online account. So I think it might be on your government gateway. You'd log in, you'd have a list of all your imports for that period. You'd be able to choose the period. You would obviously need to reconcile that to your imports that you've got on your list. You need to keep track of all your imports. If there's no discrepancy, great, you just put your import VAT on your VAT return. If there is a discrepancy, you will need to include what you believe is correct on your VAT return. So, for example, if you imported some goods at the end of March, these aren't showing on your online account, you should estimate the import VAT due and include it on your VAT return. The following quarter, once it is showing on your online account, if you need to make an adjustment to reflect any discrepancies, then you need to do that on the next VAT return. Another point to mention is that this doesn't just apply to the EU, so you can also use it for goods that you've purchased from China. So it's not that this is a simplification, or it only applies to goods coming from the EU. It will apply to all goods coming from outside the UK. Okay. But like I said, we'll try and keep you all updated as we get any confirmation from HMRC or any further information. But for now, I think that's where we're all up to.
Abigail, we've got a couple of questions for them off. Yeah, I don't know whether you've seen in chat the first one from Adnan, just for everyone's benefit. Can you explain the VAT duty element relating to purchase from non-EU and directly delivered to EU but invoiced from the UK?
So this is goods going from, sorry, let me just write this down. Sorry, go on. Can you just say that again, Rob? I can't see the chat unless I minimize.
Unless you want to unmute Adnan and just ask the question directly.
Yeah, that'd probably be easier if that's okay.
No problem. Hi all. Yeah, the question is, we purchase from non-EU, for example, Serbia, and we directly deliver to, let's say, France or Greece. And because we're directly delivering from non-EU, the goods don't come into the UK. But we're looking to invoice from the UK.
Okay, so you're a UK company, and the goods go directly from Serbia to France, and the sale happens in France. Is that correct? Yeah. What do you currently do with your invoice to your customer? You're not charging them any VAT on that invoice?
No, we have the reverse charge mechanism currently, so we're not charging any VAT, and we're not paying any VAT on the clearance either.
Are these just normal goods?
Yes. Yeah.
I think we'd need to just have a look at this, because My understanding is that if you're holding the goods in France and you're making an onward supply of those goods in France, then you might already have an obligation to register in France.
Yes, we are registered in France as well.
Okay, so you registered for VAT in France. Okay, so going forward, you would need to check with France whether you need to appoint a fiscal rep or if you need to have any fixed establishment in France. I know that some EU countries, because we're already part of the EU, countries recognise that it's okay, you can be a non-established taxable person and have a VAT registration. Now, after we leave the EU, because we're no longer part of the EU, a lot of the the EU tax authorities are saying you need a fiscal rep or something in France. So I think the first point to do would be to check with a expert in France to see whether you need a fiscal rep in France.
We already have a fiscal rep in France.
Perfect.
I was just thinking, is anything going to change post-Brexit?
I think on the basis that you register for VAT in France, as long as you've got all your ducks in order, so to speak, in France, and you've got a fiscal rep and there's no other requirements in France, I don't think this supply change for you.
Adnan, it's Gavin here. From a duty point of view, I possibly will touch on a few of these points later, but the key thing to think about is obviously the declaration that will have to be made into France. But I might touch upon that a bit later, so it might be one, as Abigail said, just to pick up afterwards. I might answer your question as we go along, hopefully. But
that's fine. That's fine.
But I think it might be more the importation side of it and making sure that you have. I'm assuming you will have the ability to obtain an EU EORI number. And that's going to be quite key, I think, to your situation as well. But hopefully we'll touch upon a few of those points, and if we don't, we'll try and pick it up at the end or afterwards directly with you.
Okay, Abigail, should we carry on with the slides? I'm just conscious we've got quite a few to get through, and Gavin's obviously as well.
Yeah, that's fine. We'll get through the slides. Like I said, if we don't get to any questions at the end, I'm around this week, Tuesday, Wednesday, Thursday, to have a chat to anyone. It is quite complicated, and some supply chains are it's never really a simple question in VAT because it's always where are the goods coming from, etc., etc. Okay, so we'll move on. So overseas VAT registration. So this is a bit, as I was saying to Adnan, about how I think he might have the obligation to register in France, but he's already registered. So I've used the Netherlands as an example. If you're moving goods or supplying goods from the UK to a business customer in the Netherlands, then at the moment, the Netherlands customer will account for any VAT due by acquisition in the Netherlands. However, following the 1st of January, if you are the importer into the Netherlands and then you make an onward supply of them goods in the Netherlands, you're going to possibly incur duty in the Netherlands, you're going to incur your import VAT in the Netherlands, and you're making an onward sale in the Netherlands. So what that means is that you're probably going to have a liability to register for VAT in the Netherlands. Now, Gavin is going to talk later about the duty, etc. So, just wait for that for Gavin to pick up. If the UK business is the importer of record, they're going to have the import VAT payable. They're going to also want to get that import VAT back. The only way to do that is to register for VAT in the Netherlands, which we think in this scenario it's likely that you would have to anyway, or you'd have to do what we call an electronic refund claim, which can be quite time consuming. So how to get around this VAT registration is all to do with who's your importer of record into Netherlands. Can your customer be the importer? Can your freight forwarder be the importer? It depends on the Incoterms, etc., which I think Gavin will hopefully cover off a bit more later. But he's the customs guy, not me. Okay, so now I'm going to talk a bit about the EU simplifications that are likely not going to apply post-Brexit. Now, these simplifications are quite complicated, and I'm not expecting them to apply to all of you. What I'm trying to do here is just to outline a scenario, and hopefully it will it will help you identify whether you do any of these supplies, and if you do, you'll need to have a think about them from the 1st of January. So at the moment, under the simplification, the UK business is selling to its French customer, and the goods are coming from the UK supplier in Germany directly to France. So this is similar to what Adnan said before. However, this is 3 EU countries, and because it's 3 EU countries, the UK company can avoid VAT registration in Germany and France and take advantage of the simplification. So the UK company will need to put this on its EC sales list if applicable. It'll be outside the scope of UK VAT, and the French customer will account for the VAT in France. However, post-Brexit, the UK company is likely to have a VAT registration in Germany or a VAT registration in France. This will depend on where the UK business takes ownership of the goods. If it's in Germany, it's likely to be Germany. If it's France, it's likely to be France. Now, the other way is if the UK company already had a VAT registration in another EU country. For example, if they were registered for VAT in the Netherlands, they may be able to use the simplification, or they could move the goods through the UK. However, Gavin may touch on this later, but if you're imported into the UK and then you're imported into France, you're going to potentially have 2 duties and 2 lots of import VAT. So it's not really an ideal situation. But like I said before, just let us know if you do have any supplies like this, and we can have a think about how we can help you. Okay, so another simplification is called call of stock. So how this applies is if you hold stock at a customer's premises in another EU country. So as you'll see, my France is no longer a circle, it is like a house, which is supposed to be a bit like a warehouse. So the UK company would move their stock into the French warehouse or French customer's premises, and the French customer will call off that stock as and when required. So for example, if it was a machinery, if it was a factory, and it said, I haven't got time to wait for the stock to come in, I want you to have a stock here, and then I can use it as and when required. Now, under the simplification, the UK company does not have to register for VAT in France, and the supply is deemed to be when the stock is called off. So once that customer takes that stock, that will be when the supply is for VAT purposes, and it can be a 0 rated supply from the UK, and the French customer can account for the VAT in France. Now, this is different to consignment stock. So consignment stock is where the UK company would hold goods in France, but it is not at the customer's premises, and it could be customer A, customer B, customer C. So it is not known who those goods will be sold to. So following Brexit, this is not going to apply anymore. It's likely not going to apply at the moment. Obviously, we don't know what's going to happen. And the UK company would need to move the stock to France, likely that they pay duty and import VAT on importation, and then they would sell to the customer. So this again would be a possible potential VAT registration in France. So if you are holding any of these stocks or have any of these arrangements, something else that you may need to consider. Okay, distance selling. So as you can see here, I no longer have a circle or a warehouse, it is now a person. So this is your typical appliances online or ASOS scenario where you're selling online to individuals. So at the moment, the UK company charge UK VAT up to the point that the French distance selling threshold is breached. So at the moment, that distance selling threshold in France, I understand, is €35,000. So at the point the sales reach that €35,000, the UK company would have to register for VAT and charge French VAT. However, post-Brexit, this is not going to apply, and there's not going to be any distance selling threshold. So on the first sale from the UK to the individual, it's likely that the UK company will have to register for VAT in France. Obviously, as Gavin may talk about later, there are the Incoterms kind of freight forwarder with the importer into France to try and avoid the VAT registration. And again, would you get your customer to account for the VAT and be the importer of record? Well, here they wouldn't account for the VAT, they just pay the import VAT and the duty because they can't recover it because they're not a business. Commercially, would you want to do this? I mean, I'm not sure I would want to pay the import VAT and the duty if I purchased some goods from the EU. So again, something to consider, may not apply to you all. I understand that the import one-stop shop will be introduced in the EU from mid-July next year for consignments valued at less than €150. What that means is you register in one EU country and account for the VAT in many EU countries if you had obligations there. But we'll have to watch this space with that and see what happens. Okay, so the last slide for VAT is about low value consignments and online marketplaces. So historically, you were able to import goods for less than £15 from outside the EU, and you weren't required to pay any import VAT. However, this is now going to be removed from the 1st of January, so that any goods purchased from the EU and non-EU they're all treated in the same way. There's no benefit from buying one or the other. Now, what they have done instead is they have changed the time of supply for consignments valued at under £135. So what that means is instead of the import VAT being due at the time the goods are imported, import VAT will be due at the time of the actual supply. So if you order goods, say from a company, sold goods to the UK company on the 1st of January, but the goods were not imported until the 15th of January, the VAT would be due on the 1st of January, and that company would have to register and charge UK VAT at that time. Customs declarations will still be required. If it's sold B2B, so if it's not an individual, it's an actual business in the UK, then they can account for the VAT under the reverse charge. So as mentioned, this is only for consignments under £135, which I understand is also the limit for duty. Again, Gavin, hopefully you confirm that a bit later on. And a consignment is a package. It's not just, so you can have 4 goods valued at £25 and that's one consignment under £135. If you have 2, say, goods worth £100 in one package, that would fall outside of this because it would be above. Another thing to mention is that if an online marketplace is involved in facilitating the sale, it is the online marketplace that will be responsible for collecting and accounting for the VAT, not the actual business itself. So for example, if a supplier in Germany used Amazon UK, it will be Amazon UK who would be responsible for accounting for the VAT, not the actual business itself. Again, this is for consignments under £135. I understand that similar VAT changes in the European Union will become effective from the 1st of July 21, but again, we'll have to watch this space. Okay, so I can't actually see the questions board, so I'm not sure if any have come through, but I don't know if it's worth Gavin talking about his duty and then we're picking them up at the end, just in case there's any questions that Gavin can answer that in his duty that he's planning to answer in full.
Yeah, I think that makes sense.
Is that okay? Yeah.
Yeah.
Okay, perfect. Okay, so Gavin, if I stop sharing my screen and hand it over to you.
Thank you, Abigail. If you stop that, I'll share mine, just pick up, then I'm not asking you to switch slides. There you go. Hopefully, is that all sharing now? I think it isn't it? I think.
Yeah.
There we go. So just a very, very quick introduction. My name's Gavin Tucker. I actually work for Customs Connect. We are in the main customs duty consultants. We've been working with Cowgirls and Lisa and Abigail on a few projects over the last month or so now, as obviously as Lisa mentioned, as people start to look to try and do something and understand at least their position from a VAT and a duty perspective. What I'm going to do now is just really kind of canter through some of the things that we're seeing, that the questions that we're being asked, and I suppose the scenarios that our clients are looking to try and understand at the moment. And I think and then actually just talking about what does it really mean to import something, because I think we're all, unless you're currently importing and exporting, I think we do get a lot of confusion around, I suppose, what an import actually is and what does it take. There's a lot more to it than obviously just packing up a lorry and putting it on a ferry and getting it into the UK. So I just want to really touch upon those points and some of the areas that I think our clients at the moment are trying to get their heads around to make sure that there isn't I suppose a complete stop on deliveries into the UK come 1 January. So Abigail's already touched upon, obviously it's quite important to to understand who the importer is, and I think, Adnan, this is probably one of the points about the goods moving into France. It's, well, who's responsible for any importation? Now, you may already have this issue anyway, and maybe not too much will change, but actually understanding who is responsible for that movement and that declaration into the UK or the EU, obviously come 1 January, is quite key. And typically people will look to their delivery terms. So Incoterms is a phrase that's often used, delivery terms, and just understanding who's responsible for what risks will at least give you some indication as to who's responsible for importation. So some typical Incoterms or delivery terms that are used is Ex Works, which means that the customer will usually pick it up from the factory, from the from the place of manufacture usually. So typically they'll be responsible for export and import. DAP actually stands for delivered at place, which usually means the seller will move the goods from export the goods from one country and deliver them to a place in another country. However, DAP does place the onus for importation onto the buyer. So in that scenario, if I was a buyer, I'd be looking at that. If I'm using DAP Incoterms, then I need to make sure that I'm gearing myself up to be able to deal with and take on that risk of importation, because I know that all my seller is going to do is deliver the goods to an address that has been physically specified. DDP, now this is the one that does cause quite a bit of issues, which is delivered duty paid. This would mean that the seller is responsible for not only the export out of one country, but the import into another. So delivered duty paid essentially means that once the goods are in that country, then as a buyer, I'm not responsible for any of the import duties or the VAT reporting that needs to take place. However, I mean, a lot of what we're seeing at the moment, you've got a lot of big retailers are enforcing DDP terms onto some suppliers. In particular, we've got 2 or 3 projects which involve the Republic of Ireland with a retailer. It's the same retailer, and the suppliers are all having to alter their supply chain so that, well, not so much alter the supply chain, but they have to make sure they're adhering to DDP terms so that they're the one responsible for importation into Ireland, which essentially means that from here on in, that UK business is going to have to register for VAT in Ireland. It will become the importer into Ireland, and therefore it will then make an onward domestic sale to the retailer in Ireland. So there's extra paperwork that needs completing in that scenario, and obviously the administration around dealing with a VAT registration in Ireland. So how do we physically import goods, what's it really take? I mean, ultimately, the declaration has to be made onto the relevant tax authority's import system. In the UK, that's sometimes referred to as CHIEF. There is a new system coming on board called the Customs Declaration Service, CDS, but that's been in the pipeline now for 2 or 3 years. Well, in terms of rollout, it's been there for 2 or 3 years. They've been developing it for about 6 years now. It's still not quite there. I think there is a gradual phase across to using it, but ultimately you need to be able to communicate with that system, and this is where it typically it would usually be performed by an import agent, a customs broker, freight forwarder. You know, they're the ones that have already got the computer systems and the infrastructure there to actually make the declaration on behalf of you as a client or an importer, effectively. Yes, you can do it yourselves, but as I put there, but you do need to have to go through there's quite an intensive capex around it all, in terms of you have to get port license badges essentially that allow you to import into certain ports, and make sure you're authorized to do that, and obviously get the IT systems talking with the tax authorities systems, with Chief and CDS. So it is possible, but I don't know of anybody that do it 100% themselves. Most of my clients at the moment, some are looking into doing it because obviously it is expensive, but most of my clients use an import agent in some way, shape or form, and that obviously is quite key. One element that is required to import into the UK and actually to import into the EU, and this is quite important if you already have an EORI number, so a European Operating Registration Identification, EORI. To import into the UK, you will need a UK one, and to import into the EU, you will need an EU one. So at the moment, most businesses might have one EORI, and you need to check the prefix on that to see which member state it was issued in, effectively. Because if you've currently got a EU one, you need to make sure you've got a UK one, and if you are going to import into the or continue importing into the EU, you do need to make sure you've got an EU one if you've only got a UK one, if that makes sense. So you need an EORI for EU and the UK now, if you want to import into either of those locations. So I mentioned the import agent. If you haven't got an import agent at the moment and you're not using one, so you haven't got any current imports, I would, and you are going to need one, I would urge you to do this now. This is they are operating at capacity. Some of the recommendations and I suppose import agents that we deal with a lot, and we are referring clients to. One of them the other week turned around to me and asked me not to refer anymore. They just cannot. They're at capacity. They can't take anymore. So if you haven't already started this process, I would urge you now to think about that and try and engage with some. There is a cost to negotiate. And that cost, as you can imagine, is going up by the day. The busier they get, obviously the demand supply, they can charge a premium. So you do need to engage with that and really understand the contract there as well around, and that's going to be around, obviously not so much the cost that they will charge you for every export and import. So for every movement, there's potentially 2 entries that's needed. So they might charge you, we're hearing costs have gone up from anywhere between £30 per entry to £75 per entry, if not more, depending on the types of goods and what they're doing for you. But typically there will be 2 entries there. There's the export and potentially the import as well, if you're doing both. So you do need to think about it on both sides of the shores, as it were. It is quite important to understand their procedures and deadlines. You don't want anything held up at port. Again, understanding that contract to make sure that you understand who's at risk if there is a delay. So if it's not your fault, but yet goods are held up at port, sometimes you can be charged what they refer to as demurrage, which basically means you're paying for storing your goods at port. Now, most import agents will make sure that that is your cost, so it is quite a key one to factor in, and it's not cheap. Again, that if you get goods held up at port, it can become quite costly. So just understanding their procedures, making sure that you've given them all the information that they need, is going to be quite important. And that that bit is key as well. They do need an import instruction. Now, a lot of them will bypass this, and effectively they will complete the import instruction. But the import instruction is quite key because it creates that declaration that goes on to the chief or the CDS system. Now, there's potentially 78 data elements there. I mean, typically that's a lot of data, but that won't apply to everybody, but there is still a lot of information that's required on that. And I think the key element here to understand is that, yes, the import agent will complete this on your behalf, but you need to understand what they're completing. You need to understand that declaration, because ultimately, if it's wrong, they will not be liable. I will guarantee you that they will not take any liability whatsoever. So they may be completing it, but within their contract, it will state that they're acting as a direct representative, which basically means they're not on the hook for anything. And I think it's quite, some of my clients will come to me and say, well, it wasn't my fault. It was the import agent's fault that used the wrong commodity code, or it's irrelevant. You'll be on a losing battle when it comes to trying to I suppose, try and push any additional duties or any penalties onto your import agent. So again, understanding that contractual relationship with them is going to be quite key going forward, and understanding that data that they do. So even if they do compile it, which a lot of them will do, you just need to make sure that you're reviewing it on a regular basis to make sure they're not using incorrect data. And some of the key points that obviously goes on to that clarification, declaration essentially is classification of the products. So what products are coming through, what duty liability is attached to those. So each product will be given a commodity code effectively, or a HS code, harmonized system code, and they're sometimes referred to, which ultimately dictates the duty liability that's associated with that product. Understanding the origin side of it as well. So again, the classification, if the products have some sort of preference because they're coming in from a country where we have a free trade agreement, then ultimately you need to make sure that we're using the right code and have the right information available to make sure that we can claim that preference treatment, i.e. those goods are coming in from. So we've potentially a free trade agreement with someone like South Korea. So just understanding that you have the certifications there to show that those goods are coming from South Korea, and making sure that the import agent understands that and make sure they flag the right boxes. And then again, valuation. So if you're not using the purchase invoice as the valuation method, which one should it be? So typically, where this gets a little bit complicated is you may be buying some goods, but for example, there might be, let's say they're affiliated to something like Disney, and you might have a royalty contract to pay as well. So understanding that connection between the value of the goods and the royalty contract, which could be two separate transactions, sometimes that royalty transaction could get dragged into the valuation for importation purposes as well, which obviously, if you don't include it, could mean that you're under declaring a duty on import. I mentioned there it was obviously just understanding the documentation that's required as part of all of this. So, and again, your agent should help you with this, and they should be pulling a lot of the information together or making sure it's there, but it's not, like I said, it's not necessarily there. Part of their contract to do it, well, they certainly won't be liable for it. So just understanding what's needed to back up that origin, to back up those values in terms of the bill of lading. So who physically owns these, obviously commercial invoice, which will obviously dictate the valuation, and the packing list, just so that they, if it needs inspecting at port, the packing list will help speed up that process and just make sure that everybody knows exactly what's in that particular container. And as I previously mentioned, we may need origin certificates, and if you're moving goods that are subject to control. You might need an import or an export license. And this is something that actually cropped up for a client of mine recently, which I don't think a lot of people had really picked up on. But at the moment, I mean, my client imports tropical aquarium plants, and they're currently coming in from Denmark, actually, into the UK. Now, they're not dangerous goods as such, but certainly they are subject to greater scrutiny on importation, and they do have to be registered with a different department within HMRC. And it turns out that I hadn't appreciated this, but every container will have to be inspected. There's a different system, well, an additional system, not a different one. So they still have to declare the imports as they would any other goods, but they also have to report the movement of those goods on a completely different system called Peach, which is basically making sure that you need a photosanitary certificate to move with those goods, which basically explain exactly what those plants are, whether they are dangerous or not, and obviously what use they will be put to. So there is some added complexities if you've got anything subject to control. But I'm going to hazard a guess that if you're already moving those goods, you'll probably be aware of those. Although I have to say they weren't in my situation. But it's just worth bearing in mind if you're moving anything a little bit unusual. Maybe, although food, all right, you might not say food is unusual, but the Peach regulations can apply to food as well. So can any of this importation be simplified? I think Abigail touched upon it. Yes, you can apply for, and you do need to apply for it, for simplified procedures. This can be used between January and June effectively. And essentially what it tries to do, it's going to try and break you in gently. If you've never imported or exported before, you only need to, on the initial declaration that's made, you only need to give limited information, basically. However, that full documentation needs to be submitted. I think that's referred to as a supplementary declaration, and that's got to be done within 6 months' time. Now, that will give you a benefit of duty deferment. So the duty will only be payable upon that completion of the supplementary declaration. So you will get a cash flow benefit from that as well as if you're using this system, then potentially, obviously, you could use the postponed accounting, VAT accounting as well. So ultimately, you can derive a benefit from it. However, you know, there are, I suppose, I've got some clients that have said, well, okay, they already operate a duty deferment account anyway, so they can manage the cash flow. The limited information element of it, you need to make sure that you're capturing all the information on entry anyway. You don't want to be looking back in 6 months' time thinking and pulling all the information together. So quite a few of my clients are not really opting to do this. But like I say, they already have the duty deferment account in place that gives them the ability, or gives them a potential cash flow benefit anyway. So they're not everybody's jumping on board with this one at the moment, at least anyway. But I think its heart's in the right place, and I think it will help people that have never imported before. But I think if you have imported before, it might have limited use, as it were. So can costs be mitigated? Obviously, due to VAT, in theory, should be recoverable, subject to your partial exemption status and what you use those goods for. Obviously, duty is an absolute cost. So one of the areas that we as a business look at is whether we can save that duty. So what can be done to mitigate it? Obviously, I've mentioned duty deferment. So the simplified declaration could give you a 6-month duty deferment. However, I suppose the regular duty deferment accounts essentially can buy you, I think it works out about 30 days worth of cash flow benefit. So you're not physically paying the duty on importation. It goes to your duty deferment account, which then gets settled in the following month of import, basically. So you need to apply for that. There is and you do need a bank guarantee there as well. So there is a cost to duty deferment as well. Correct classification, as I mentioned, each product that's imported needs to be assigned a classification code, and understanding what that classification code is and making sure you're using the right one. As I mentioned, it does dictate the duty liability. So just making sure you've got the correct one. One of the areas that we often find is that brokers or the suppliers, even if they've not done a full classification exercise, they might drop it into, if you've ever done one, the codes break down and you look through it, a bit of a, I suppose, a decision tree of, for want of a better phrase, in terms of, does my product fall into this one? If not, no, I'm falling into the next category. If it's not in that one, I fall into this one. Effectively, you can work your way down, and most classification codes will have an other at the end. And typically that other one it's usually, if people can't be bothered, they drop it into the other. But as you can imagine, the other typically has the highest duty rate, and actually spending a bit of time to see if it falls into the other categories above it might actually save you some duty. So spending a bit of time looking at the classification can sometimes hopefully reduce your costs, or at least avoid penalties in the future when you're using the wrong code. I've mentioned origin, so that's you generally referred to as a generalized scheme of preference. And I think somebody has asked the question around, I suppose, going forward, how beneficial is this going to be? There is, obviously, we will be agreeing free trade agreements. We've agreed some. I think the latest one that they're banging the drum on is the Japanese one that was agreed a few weeks ago. So origin will still be of use in the future. How much it would be of use if we have a deal with Europe is another big question, though. I think unless we've got some sort of, they use a phrase called culmination, where you can kind of combine products from different countries, and depending on the percentages used, you may be able to obtain a preference code to say that these goods, whilst they came into the UK, actually came in from a country where the EU or the UK have some sort of free trade agreement with, and therefore you can make use of the reduced rate of duty. I think it's probably a little bit too early to tell as to how useful origin is going to be going forward, and that will really come down to the nuances of any deal that's made to a certain extent. Because if a deal is made, then to be honest, origin might prove tricky, because obviously what the EU don't want is the UK being used as a bit of a backdoor to get goods into the EU under a lower rate of duty. Suspensions, similar sort of thing really with suspensions. This is a regime that's been around for quite a while. We're still waiting on the UK to agree their suspension, or at least give us more detail on what their suspension arrangement will be in the event of a no deal. But this essentially says that if the goods that you are importing cannot be sourced in the EU/UK, then you can apply for a suspension and get the duty rate reduced, typically down to 0. But at the moment, that has to be agreed by obviously all member states of the EU, because obviously it is a trade protection situation where obviously what they don't want is to reduce the duty rate to 0 when you might be undermining a manufacturing part of your country or the member state effectively. So usually what happens is, and this is kind of what we do, is we'll kind of make an approach to the EU at the moment and say these goods on behalf of an importer are not manufactured in the EU, and you have to wait for every member state to come back and say yes, we agree with you, or no, we don't. We believe these goods are manufactured somewhere in Eastern Europe or or wherever it may be, and they'll either agree or disagree to the issue of a suspension. But suspensions can be quite useful, and obviously are going to be potentially very divisive in terms of any in a no deal situation, where obviously the UK can now say, well, these goods are no longer manufactured in the UK, so therefore we're going to drop and we will happily allow suspensions to work. So it is a bit of a watch this space on that. And tariff quotas, some products imported have a you can import so much tonnage or so much volume of it at a lower duty rate, but as soon as it exceeds that, then it goes back up to the full rate of duty. So just just checking to see whether your goods fall within a quota. Inward processing under customs control, and outward processing. These are, I suppose, authorizations that can be applied for, which essentially suspend duty coming into the UK or the EU as it currently is, while you manufacture them. And then once they're manufactured, you know that those goods are going to be re-exported out of the EU as it currently is, or potentially going forward out of the UK. And essentially by suspending the duty coming in, working out then what you've done with those goods in terms of manufacturing, and once you know what you've re-exported, then obviously you can do a calculation that says, well, because I've re-exported X, therefore Y must have stayed in the UK, and therefore Z is how much duty I now have to pay. So I suspend all duty coming in, and I only pay duty on what remains in the UK. Yeah, they're processes that do need to be authorised by HMRC currently, and will be. Inward processing, I think, is something that an outward processing is something that really could be useful in the event of a no deal, especially if you're buying goods in from Europe, manufacturing them, doing something with them here in the UK to either be exported out to the rest of the world or back to the EU. I think that there's going to be a lot of opportunities there to try and mitigate duty liabilities. And very quickly, Northern Ireland, it's not a topic I like to talk about because it does seem to get quite complicated. The key bit here, and the key message I want to get across here, is that it's this Route 1 that's going to change quite significantly. So this is where we're moving goods from Great Britain into Northern Ireland. So this is where new declarations are potentially going to be needed, and potentially duty is payable, even though you're moving it within the same, I suppose, the United Kingdom, as it were. But if those goods are considered at risk of moving into the Republic of Ireland, then duty might be payable at that stage. So moving goods from Northern Ireland back to the Great Britain, Northern Ireland to Republic of Ireland, and Northern Ireland to the rest of the world, that shouldn't really change. It's the key bit is goods moving from Great Britain into Northern Ireland, and the new declarations that'll be needed there. The key message, I think, right now is you need to register on this trader support service. I think that I was listening to a webinar last week. They are offering quite a lot of support. In theory, this trader support service, which will be utilising, I mentioned earlier, the CDS system, so the Customs Duty Service, Customs Declaration Service. It will be utilising that, but they will do a lot of the work for you. They're not a consultancy service. They're not there to really help you with your supply chain, but what they will do is they will help you, and this TSS system will actually make the declarations for you that need to be done into the way you're moving goods from Great Britain to Northern Ireland. So this is a slide that I have blatantly stolen from HM Government on their presentation that they did last week. There is a QR code there. I've not tried it, but in theory it'll take you through to that tradersupportservice.co.uk. They're offering quite a lot of training at the moment, so it's worthwhile registering and just making sure that you are up to date on a lot of those on that situation, I suppose. Now that was a very quick canter through, so I know we're a little bit pushed for time, but if anybody's got any questions.
I think thanks for that, Gavin. There's one bit you, which was asking how businesses go about who do they contact the EU ERE number?
How do we apply for one?
Yeah, who do they need to contact to apply for a EU ERE number?
Well, so your EU ERE number will you effectively need, I suppose, to a certain extent, you apply with the country of where your import is going to be, I suppose. So typically, if you're importing into the Netherlands or into France, as was mentioned earlier, then you would apply for a EU ERE with that particular tax authority. That ERE number will work then across the rest of Europe within the EU. So you only need one ERE within the EU. Typically, you would apply for it, as I mentioned, in the country where you do import. So obviously, the Netherlands, for example, they're going to be inundated, it's that particular tax authority. But taking a step back and thinking about I suppose the bigger picture there in terms of, do I need a VAT registration as well? Because obviously, if you are importing into that country, then as Abigail mentioned, then you do have the scenario where you're then making an onward sale of those goods to a customer in Europe. So does local VAT have to be accounted for? There's an element as well to consider around establishment. The creation of establishment, and Abigail mentioned that there's quite a few countries requiring fiscal representation. So I suppose just thinking that through and talking to someone like Lisa around, well, what does that creation of that establishment really mean in terms of people on the ground? Just to clarify that there aren't any, I suppose, other taxes that need to be considered is something I usually do flag as well.
Great, thanks, Gavin. Judy, you had a couple of questions. I'm conscious of time. Did you just want to unmute, Judy, and just ask one of those questions, and then we can follow up with the others over email? Is that okay, Judy?
Yeah, sure. I muted myself.
Yeah, you fire away.
Okay. Yeah. So one of the questions was, is the new VAT rules importing into the European Union only applicable if no free trade deal is reached?
So I think that the rules are going to change because you are importing. So for VAT purposes, it is going to be import VAT instead of acquisition VAT. So in that case, that is going to change no matter if there's a deal or not. But from a duty perspective, Gavin, I don't know if you want to follow on this, but I understand that it's whether we reach any agreements with the countries that will affect the rate of duty or anything like that.
Yeah. So we've left the EU. So whatever happens, whether there's a deal or no deal, that a import-export declarations will have to be made. The whole point around the deal is whether we then have to pay duty on that movement. And I think there's a lot of people coming to me and say, well, hopefully there'll be a deal agreed and we won't have to worry about this. I think everything that the practicalities that I've just been through are relevant whether there's a deal or no deal. Those points to a certain extent all have to be considered because the paperwork will have to be done, unfortunately.
Yeah, so I mean, we do a lot of direct sales from the UK to European consumers. I think the practicality point really is who's going to be responsible for the VAT import into the European Union. We would rather save our customers trouble by being responsible for it. And but obviously we need to look into the cost of doing that. But the thing is, if we're shipping to 1,000 consumers and they're all across 26 different European Union countries, how do we go about doing that without having to use a warehouse in Europe and import directly into that Europe, can we still do practically, can we still ship from the UK into these countries without a lot of trouble for us? And the administration costs associated with that might be quite significant.
Yeah, I think, Judy, I mean, I think, was it one of your questions you asked about obtaining advice in the local countries? We do have contacts in the other countries. We work with a company who are able to look at VAT registrations and VAT returns, etc. So if you let us know which countries you want to look at, I can maybe facilitate a call to understand in that country, and then you might, I guess your alternative is something like a warehouse going into one country and then selling out of there. But it will just, a lot depends on the specific rules in those countries, so you are probably going to have to get advice there if you are acting as importer into them countries.
Okay, right.
I think Judy as well, it's probably worth, I don't know who you use logistically to move those goods. So the kind of individual package, if they're individual packages and you're using somebody like DHL or Whistle, or engaging with them now just to understand what they can offer. There's one or two have started to offer a relatively good service around how to manage that, especially when you're dealing with consumers. Because obviously, you're quite right. I've got one client who, they're very low value items that are coming from the UK going off into Europe. So do we effectively just continue to use what they refer to as CN22s, which is essentially, it puts the onus on the consumer to deal with the import, or actually do you deliver them DDP? Like the scenario I was talking about earlier, which obviously then potentially brings you into the realm of, well, how do I get the goods into Europe, physically importing them into Europe and then distributing them? Because obviously, there's a logistic issue there around, well, how often am I moving goods into Europe, I suppose, and where the touch point of where that's got to be. So the import one-stop shop, for example, might be really useful to you, but unfortunately in Europe that's not coming in until July. There's probably a bit of a gap to bridge there.
Okay, thank you.
Thanks, Judy. And as I said, we'll make sure that we send the slides around to everybody, and we'll contact you, Judy, over email with Abigail and Gavin as well, because I know there might be another question. But we'll leave it there. Lisa, I'll hand over to you to close, if that's okay.
Yeah, that's fine. Obviously, we've tried to cover quite a lot of concepts, complex concepts, in a very short period of time. So I'm sorry if we've blown your mind a little bit. As Rob said, we will be sending the slides. The contact details for Gavin and Abigail are on that. Obviously, the situation is still fluid, and therefore, as and when we know whether there's a deal or no deal, we will obviously continue to update you through our newsletters and sort of on our website. So if you keep an eye on that. And also, I'll just remind you about that webinar as well on the 8th of December. The Chamber, when they're on that webinar, they've got access to a lot of information, certainly through their website, and just generally, they will be able to assist you. So it would be worth attending that, really, to see if there are easier ways, instead of you just, as Gavin said, there are easier ways collectively where you'll be able to access the EU, and they will help you with that. And then also about the EU nationals, I know even within our business, we have people that are EU nationals, whereas in the past we would just, if they've got a right to work in the UK, we would be very comfortable. But there is other processes now, sponsorship that needs to be sought if you do have people that are EU nationals working in your organisation. And then if you're planning to take on EU nationals in the future, I'll leave it at that. Obviously, if you've got any questions, you probably all know Rob. So if you want to use him as a conduit, that's great. If not, please feel free to get in touch with Abigail or Gavin directly. Thanks for your time.
Thanks, everyone.
Thank you, everybody.
Thank you.
Thank you.